Bloom Energy did not just beat earnings. It blew through the ceiling investors were using to value this company. For the first time in its history, Bloom generated more than $1 billion of revenue in a single quarter. Revenue grew 166%. Product revenue grew 215%. And the company did it while expanding margins, producing real GAAP profit, and generating more than $200 million of operating cash flow. That combination is the story. Growth, profit, and cash arriving together. So, did Bloom just prove that the AI power shortage can become one of the market's biggest investment opportunities? Let's look at the evidence. Bloom reported second quarter revenue of $1.065 billion. Wall Street was looking for roughly $850 million. Adjusted earnings came in at 78 cents per share, compared with an expectation near 41 cents. But the best number may be gross margin. GAAP gross margin reached 33.4%, up nearly 7 percentage points from last year. Operating income swung from a loss to $182 million. Operating cash flow swung from negative $213 million to positive $226 million. This is not revenue being bought with weaker economics. The economics are improving as Bloom gets larger. Now here is the number that may matter most after the recent controversy around Bloom's project finance structure. In the first quarter, Bloom disclosed roughly $373 million of related party revenue. In the second quarter, that number fell to just $2.8 million. And yet total revenue still climbed 42% from the previous quarter. That does not eliminate every accounting question, but it is powerful evidence that Bloom's growth is not simply being manufactured through sales to Brookfield joint ventures. The underlying customer deployments are scaling. There is still concentration risk. 2 customers represented about 65% of quarterly revenue. That deserves attention. But for a company ramping enormous data center projects, concentration at this stage is very different from a lack of demand. Management did not merely celebrate the quarter. It raised the entire year. Bloom's previous revenue range was $3.4 to $3.8 billion. The new range is $3.9 to $4.2 billion. At the midpoint, Bloom expects to double revenue from 2025. The midpoint of operating income guidance increased from $675 million to $850 million. And adjusted EPS guidance moved from about $2.05 to $2.70. That is not a small adjustment. It says the second quarter acceleration is expected to continue. The reason is simple. AI companies do not only need chips. They need enormous amounts of dependable electricity, and many cannot wait years for the grid. Bloom can place modular fuel cell power directly beside a data center and deploy it far faster than new transmission or a traditional power plant. Management now says every major U.S. hyperscaler, plus more than a dozen neoclouds, AI labs, and colocation operators, has validated Bloom's solution. Oracle's expanded agreement contemplates as much as 2.8 gigawatts. Brookfield has expanded its financing partnership with Bloom to $25 billion. And management says customers are placing longer-term orders, with backlog growing faster than revenue. This is how a product becomes infrastructure. The bull case is strong, but execution still matters. Bloom must expand production without sacrificing reliability. Investors should watch customer concentration, warranty costs, project timing, and the company's disclosures around scandium supply. The quarter also benefited from a $37 million tariff recovery. Although even without that benefit, underlying gross margins still improved year over year. The stock will remain volatile because expectations are now enormous. But this earnings report answered the most important question. Can Bloom convert the AI power shortage into revenue, profit, and cash? Right now, the answer is yes. Bloom is no longer asking investors to believe only in a future story. It just delivered $1 billion of quarterly revenue, a major profit inflection, positive cash flow, and another guidance raise. If Bloom keeps converting long-term demand into 30% plus gross margins and real cash generation, this may become one of the defining infrastructure companies of the AI build-out. That is the opportunity investors cannot afford to ignore. If you enjoyed this breakdown, leave a like and subscribe to Risk on Capital for more company deep dives and investment stories.